Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. Teach intermediate accounting 1 and 2. And today's lecture is for my intermediate accounting 2 classes. We're going to be working problems on the equity chapter from our textbook. We use the McGraw-Hill intermediate accounting textbook, the Spicer-Nelson-Thomas book. Love the textbook, so I'll just give them a lot of credit for the materials they provide to help me teach, which I'm using today. Thank you. So I think I'll start here with just, I have a summary sheet that I provide to all my classes. And, it's hard, if you're not in my class, it's kind of hard to send it out to you, but you can see it here. This is just for all my intermediate 2 classes, I try to provide a 1-page summary of kind of important things to know, because it seems like in intermediate accounting, there's, a lot of things to know. None of it, by itself, maybe except for deferred taxes, too complicated, but just a lot of nuances in accounting. But that's, if we didn't have that, we couldn't make the big money. You couldn't, that CPA, everybody would have one, right? And so that's important. So the journal entry for issuing shares, we're going to debit the asset or cash or the expense account, whatever we receive, and I'm going to debit that at the fair value of what we receive. At that, we're going to credit the common stock to par value, if there is a par value, times the shares issued, and whatever's left over, kind of another plug number there, if you will, goes into additional paid-in capital, additional, over and beyond the par value. If there's no par value, we just debit the asset and credit common stock. We don't have to worry about additional paid-in capital. Now, if we repurchase shares, in today's problems, I'm going to work the Treasury Stock method. We could retire the shares, which takes them completely out of the common stock account, the APIC account. You can, go look at my last lecture if you want to see that. Today, I'm going to talk about Treasury Stock. The first entry, when we purchase the shares, I call it the easy entry, because whatever the amount we pay in total, credit cash, debit Treasury Stock. That one is easy. The next one, I still think it's easy, not as easy, is when we go back and we sell some of this Treasury Stock. And we sell it, we've got to remember, hey, what we paid for it when we took it out up here in the first entry. So we're going to, debit cash, because we're selling this time, we're receiving cash. And we're going to credit common stock for the original purchase price times the share sold, back up in here. And then we're going to credit any difference to Treasury Stock, APIC. Now, if there is no APIC, the whole APIC, Treasury Stock APIC account must have a credit balance. If it doesn't, then unfortunately we'll have to credit, we end up with a debit there, we debit retained earnings. And we'll see that in one of the examples I worked today. Dividends. There's only 2 journal entries for dividends: when the dividend is declared, because at that point we have a legal liability to pay that dividend. So we're going to credit the dividend to payable and reduce retained earnings. The second entry is when we pay that, we're going to credit cash and debit the dividend payable. Again, no entry on the date of record or the ex-dividend date. That's when we just have the right list of shareholders who are going to get paid. So if the stock dividend is, now we're going to look at stock dividends separately than cash dividends. And if it's less than 25% on the declaration date, we'll credit the common stock account for the new shares times the par value. Well, first of all, let's look at this. We're going to debit retained earnings for the new shares times the fair value per share. And we only use that fair value per share if it's a stock dividend less than 25%. If it's greater than 25%, we're not going to use that fair value because it's not going to be right. The stock dividend is greater than 25%. The stock price is going to drop proportionally to the new shares on the market. So again, if it's less than 25%, debit retained earnings for the total new shares times the fair value. Credit common stock, obviously, shares issued times the par value, and any difference goes to additional paid-in capital. If the stock dividend is more than 25%, we could adjust the par value so we keep our common stock account right, proportionally, and I have no journal entry, that's a lot of crazy amount of legal work and everything else. So mostly what company's going to do is going to debit at APIC and credit common stock. Again, why do we credit the common stock? Because we got to keep the common stock account, if shares have par value, always equals the number of shares issued times the par value per share. Okay, so with that, let's get started, or let me get started. And well, I hope that you'll get started here and that you'll work some of these problems also. You know, as you know, if you've been keeping up with me here, I suggest that you pause your video, work this problem, then come back and watch me working. So with that, let's get started. So 18-3, we're issuing 100,000 shares, and not for cash this time, but for legal work. And the Morgan law firm has done 4,000 hours for us, and our usual rate is $240 per hour. I assume that's the fair market value of the services. So we're always going to debit, you know, the asset, in this case, the expense, because we've got legal expense, times the fair value of what we received. And so that's going to be, you know, get my calculator out, 4,000 times 240, $960,000. So legal expense, $960,000. And then we're going to credit, and I'm going to just use CS for common stock here throughout this. You know, I like to use acronyms, just keep it easy. And we got 100,000 shares and they're $1 par value. So this is easy. Number of shares issued times the par value. Don't miss that. And then this, I'm going to call it APIC, additional paid in capital. Your textbook calls it paid in capital dash excess of par. You know, I'm not going to count my students out if they put APIC, since I'm using it here. And that's just the difference. 960 minus 100, 860,000. Basically, get the debits and credits right on that. But, you know, if you think about it logically, this is the, we received $960,000 of value. We put this in the common stock account, and this is in excess of that par value. Man, this chapter is too easy for you guys. So let's do 18-8. I'm gonna have to make it hard somehow for my students. You know, of course, it's kind of a makeup after deferred tax, because that is, I would never say that deferred taxes are easy. So opportunity on the next exam, this area, I think. 18-8. So so we're going to reacquire 2 million Treasury shares at $20 per share, and later 1 million shares at 26. So we've got you know, a couple of entries here. Let's do both of those entries. So we're going to debit you know, a 2 million times 20. So debit Treasury stock. I hope the, you know, I'm afraid some people will miss that, so I'll write it out for right now. Treasury stock, that's 20 million, 2 million times $20 per sale, 40 million. Credit cash. And the next entry, we're going to debit Treasury stock. I call this the easy entry. 1 million shares at $26 per share, so 26 million. Credit cash for 26 million. Now I know what we did in my company. We kept a little spreadsheet because we got to know how many shares are out there in this treasury stock, because you can't look at the balance. You could look at the balance of the common stock account at any point, divide that by the par value, you know how many shares are issued. You do not, you cannot see that through the treasury stock. You could see what's the average that you've paid for all treasury shares, because the number of shares will be on the balance sheet, and we'll I hope we might see that. Okay, so we've got, here we've got 2 million shares at 20 and 1 million shares at 26. Why do we keep this back in our spreadsheet somewhere? Well, if we reissue these shares, we've got to know this. And so let's go see what's going to happen here. I bet they're going to sell some shares. Ah, yes. Now we're selling 1 million shares at $29 per share. Now, first of all, we bought all these at 20 and 26. We're selling them at 29. Gain. No, here's the one rule. You cannot record a gain or a loss on the sale of your own company stock. So what happens? All this stays in equity. That's right. First of all, that makes sense. You can't have a gain selling your own stock. That would make no sense from the accounting rules. So we're going to go sell 1 million shares at $29. So first of all, I know we're going to receive cash, 29 million. But now we got to reduce our treasury stock. Now, this says here, you could do it 2 different ways. You got to be consistent, whatever you decide is your accounting policy. You could use the weighted average to pull these out, or you could use the FIFO method. And so number 1, weighted average, number 2, FIFO. So it's kind of like inventory, except you got treasury stock. So we've got 3 million shares for 66 million. That's 66 divided by 3. The average share price is 22. So we use the average method, and we sold 1 million shares. It'd be 1 million shares times that $22 average, 22 million. Got some left over. So APIC, 7 million. So key point here is that you don't care about the par value. You don't care what you originally issued before, none of that. All you care about is what price you bought them out at. And you bought 3 million shares for $66 million. Average cost was 22. So you pull them out of the treasury shares. And so we had 3 million treasury shares. Now we've only got 2 million sitting in treasury shares. And we've reduced the value of our treasury stock. We had 66 million in treasury. Now we only have 44 million. Now let's do number 2. We still debit cash for 29 million. But we're going to credit treasury stock. We use a abbreviation there. And we say, hey, use the FIFO method, okay, like inventory. First in, first out. The first one's in, we're at 20. So I take 1 million shares I bought times 20, and I pull them out. And I still have the remainder in APIC, 9 million. Oh my God, too easy, too easy. $18.5. Rolling. We are rolling along. I'll let you guys pause. I will pause here just for a second. You stop the video, go work this. You can do this for sure. Okay, welcome back. You got 2 million February 12th. We sold 2 million shares for $9 per share. So I know right off the bat, debit cash, 2 million times $9 a share, 18 million. And what's our par value? Our par value is $1. So we're going to credit the common stock for number of shares we sold, 2 million times $1, 2 million. And the remainder goes into additional paid-in capital. And that's just get our debits and credits right. 18 minus 2, 16. February 13th. We issued 40,000 shares to attorneys in exchange for legal services. Now, they don't give us the value of these legal services. So the only thing we can go on is so we don't know the value of the legal service. Do we know anything about the value of our stock? Well, just the day before, it sold for $9 a share. So maybe we'll just use that. And so legal expense, $9, that's $9 times 40,000. 360,000, and then common stock. This part's easy, same as whether it was cash. Number of shares issued times par value. Okay, I got that. 40,000, and the rest goes into additional paid-in capital. 320,000. All right. February 13th, we also sold 80,000 of its common shares and 4,000 preferred shares for a total of $945. All right, so we're going to receive cash, debit cash for $945,000. Credit common stock, and I assume that we sold these for the $9. Let's assume that, but we got to put that at par value. That's just a $1 par value times 80,000. We may want to keep it's separate, APIC for common stock and APIC for preferred stock. We can do that. So APIC for common stock would be that $9 that fair value times 80,000, 720 minus 80, 640,000. So I got total of 720,000, right? Divided by 80,000, $9. Okay. Preferred stock, the accounting for that, exactly the same as common stock. We put it times the number of shares, 4,000 shares. Now, preferred shares is going to have, potentially going to have a higher par value because we use the par value times the preferred share rate to calculate dividends. And so that's why you see $50 here. So 4,000 times 50, 200,000. I can do that math. Don't need my calculator. I almost pulled it out. And so what's remaining after this? I got 840, 920. I got 25,000. Check my math. 225, 825, 865, 945. Check. My debits and credits equal. I don't want to screw up here and then confuse everybody out there. And then finally, on November 15th, and these are really good examples of issuing things besides cash for equity. So we're going to issue 380,000 of the common shares in exchange for equipment. And we know what the cash price of the equipment is. And so we put ever this asset in that we're going to get, and we're going to debit equipment. Goal is to derive the fair value of whatever asset we receive. This we've been given, 3,688,000. If we don't have the equipment, but we know the fair value of the common stock, then we infer that's the fair value of the equipment. We have it here. And we're going to credit common stock. Same thing every time. Par value of $1 times the shares issued, 380,000. and then credit APIC for the remainder, 3,308,000. Awesome. Keep in mind, the common stock and the APIC accounts, the preferred stock and the APIC preferred stock accounts, those are what we call paid-in capital accounts. That's one of the two most important parts of equity are paid-in capital and then retained earnings. Owners, they really love that retained earnings and they want to see a lot of earnings, right? And they own those earnings. That's why they have equity. Okay, looks like we've got another treasury stock example. That's good because I will have these on my exam. Hopefully, if you're watching this from another school or whatever, you may have the same thing. We had issued 140 million shares, dollar par value at $17 per share. Now, we're going to look at these new transactions. Okay, we reacquired shares and we used the treasury stock method. And this was 123, debit, treasury stock, credit cash, same entry every time. And it's 10 million times 20. $200 million. And then we sold 1 million of these at $21 per share. And this is September 3rd. So we're going to get cash for this, right? So cash equals 21 million. And we're going to credit treasury stock. When we buy it, it's the easy entry. When we sell it, it's still easy, but we got to remember, what did we buy this for? We pulled them out. We credit treasury stock for the exact amount we paid. How much did we pay for these? $20. These were $20 per share. So we're going to pull these out at 20 times 1 million. That's easy math. And we're going to credit APIC for the difference. 1 million. So back in the accounting offices, and true back in my accounting office, they're tracking all this, so they know how much is in APIC for treasury stock. They know, they'll know right now that we've got 9 million treasury shares at $20 per share. They're tracking this in a big spreadsheet so that when they can do these next entries. And that's going to be important when you see this next entry, because we're going to run into a bit of a problem on the next entry. I've looked ahead, okay? Debit cash for 18 million. And by the way, just taking a step back, we're going to sell these at 18. We bought them for 20. We lost money. But again, no loss or gain on selling your own company stock. But because there is kind of a loss here, we are going to have an issue, because when we run out of the amounts we put in APIC for treasury stock, then we have to hit retained earnings. That's the one twist here that you're going to see in this problem. So I'm going to credit treasury stock for the 20 we paid. This is how many? 1 million shares. But I don't have APIC. I have negative APIC. So we got to do some gyrations here. How much total do we have in APIC? We can pull anything we put in APIC for treasury stock out. Well, we put 1 million in, so let's put that back out. But now there's 0 left in APIC. And we still have a problem. We're 1 million short. Guess what? Retained earnings. It becomes like a return of capital then. So that's a good problem to see. So now we've got 20 million in debits and a $20 million credit. So I think that was a good problem to think about in terms of, seeing how that hits retained earnings. Okay. 1813. Again, I don't know if I've been pausing. You pause the video and go work this, and then come back and see if you got it right or not. Practice makes perfect, at least. Let me see one thing. Yeah, one more. So 18-13. All right. On February 12th, Mega reacquired 1 million shares at $13 per share. And this is on February 12th. And by the way, this is the easy entry. Love this entry. 1 million at 13. So that's at 13 million credit cash. The easy entry. June 9th, same, another easy entry. I love it. 2 million at $10 per share. So we're gonna have 20 million here. And we paid cash. And so how many shares of treasury stock will we have? We want to understand that. We got 1 million at 13. And we've got 2 million at 10. Okay, on 5/25, the next year, 20, we sold these. We sold 2 million at $15 per share. Hey, well, if there was going to be a gain, we had a gain here. We sold this for more than we bought them for. So it's a win regardless. And so debit cash, 2 million times $15 per share, 30 million. And we're going to credit treasury stock for how much we paid for it. And we're going to use the average method. So we've got 3 million shares. We got 33 million in treasury stock, 33 million, and that's 3 million shares. So $11. And does that make sense? I always look, yeah, 2 million at 10, a million at 13, 11 seems like a good, that seems like that's probably right. So then we take treasury stock out at, and how many do we require? 2 million at 22 million. And we have APIC. We'll have to hit retained earnings this time for 8 million. Now they ask us, well, do the same transaction, but do it on FIFO. Well, that's easy enough. Debit cash, that doesn't change. We sold 2 million shares times 15. And if we do FIFO, and it was 2 million shares, right? So 1 million at 13 and 1 million at 10. And I think that's going to be 23 million. And credit APIC for the difference. 7 million. Where does the 23 million come from? FIFO, $1 million at 13 million from up here. And then next ones were $1 million at 10 million, total 23 million. Again, work quite a few of these treasury stock problems, and I want to, because going to be on my exam. I don't know on your exam, wherever you might be. But again, we debit treasury stock in the easy entry for whatever cash we paid. And we credit the treasury stock when we resell it, but we pull it out at exactly the same amounts that we paid for them originally. And then we could use a weighted average method, or FIFO, doesn't really matter. So, all right. Last problem, and it's a long one. Hopefully, I don't know if you can see this map at all here. Maybe I'll pull this out just a little bit, make sure you can see it. And I'll pull this back. I can't win here because now you may not be able to see my writing, but I'll tell you what, I'm going to pull it out and then I'm going to take it back. I'm going to pull it out so you can maybe hopefully see it, so you can pause your video and go work this. Okay, well, I'm going to earn my money today working this one, because there's a lot of work here on this one. And one of the issues you're going to see, I've worked this before in class, is that the share counts are going to keep changing here because of what we're doing. All right, I think that's going to work. So March 3rd, let's see what we did March 3rd. We declared a property dividend of 240,000 shares of Leaseco International at a book value of 700,000. So this, for my classes, they haven't seen the investment chapter 12 yet, because I cover that more towards the end. So one little curve here, we have to get Leaseco up to its right fair value. So, and that's going to be $3 per share is the current investment value times 240, 720,000. So this is really first thing, we've got to get Leaseco at, it's an investment in another company. We've got to get it the right place. And so we got increased this investment in Leaseco from 700,000 to 720. So because our dividend needs to be recorded at the fair value of what we're providing people. And we're not providing the book value of 700, we're providing the 720. Now, March 3rd is a declaration date. So they declared a property dividend. Boy, I hope no companies declare property dividend. I don't want any of their property. I just want cash. But that would probably be more unusual. So we've got same entry though that we would normally make, retained earnings, 720,000, which is the value of Leaseco, and we're going to credit property dividend payable March 3rd. March 15th, date of record, no entry. I can see how the multiple choice is going to grab some of you, because if we give you all this data, the date of record, and you can say there must be an entry here. No entry on the date of record or the ex-dividend date. And so the next thing we're going to have is this property was distributed on March 31st. So we're going to take this investment in leaseco is now 720. It's going to come out. We're going to reduce the property dividend payable. We set it up with this entry with a credit, and now we're going to debit that. And we're going to credit. We no longer on the investment in Lisa. We've given it to our shareholders. I assume maybe in some smaller corporations, this is the kind of thing that happens. All right, some more. This is a whole dividend problem, and it's kind of an interesting one. So on May 3rd, we have a stock split, a 5-4 stock split. The stock split was affected in the form of a 25% stock dividend. The market value was $11. Now, guess what? 25% stock dividend considered a large stock dividend. Therefore, we're going to ignore that market value. All we're going to do is get the common stock account right, because we got a new number of shares, 25% of shares outstanding. Now, what are shares outstanding? You got to calculate that. Equal issued minus treasury stock. Remember, that's why we really only shares outstanding receive dividends. And so if we look up here, we have 364,000. See, this is a hard problem. This could get you in a multiple choice. So 364,000 issued. How many treasury shares? Well, I can't see it here, but guess what? It's over here. We always, on the balance sheet, will always show a dollar amount and the shares that are in treasury. And so here we have 4,000 shares. Minus 4,000 equal 360,000. So we've got 360,000 shares outstanding, and each one of those shares is now, each shareholder is going to get a 25% more shares. So 360,000 times 25%. $90,000. There are 90,000 new shares now. So our common stock account is wrong right now. And again, large stock dividends, we don't consider that market value. So we are going to go in here and debit APIC. And what's, let me read that. And we're going to credit our common stock account because there's new shares. 90,000 new shares. Par value is $1. Right here, I can see it on the balance sheet, $1 par. So common stock is going to be 90,000. And I'm going to take it out of APIC. Some companies do take this out of retained earnings. And so it's kind of there's nothing wrong with that. And I believe GAAP would allow either way. So textbook shows both are allowed. So make sure you get that. I kind of, on my last lecture right at the end, I saw that down there and I kind of frazzled out a little bit. So now that's what that was about. So now if you've been through with me in that whole lecture to the very last minute, which I don't know many of you were, but if you were, that's what happened there. We could have debited retained earnings, but I'll be fine with either answer. I think APIC might be a little better answer in that regard. Now, we got to think about how many shares outstanding now. You better keep a record of that. We might need that. I will tell you that we is 360,000 plus 90,000. We now have 450,000 shares outstanding. We might need that on the next. And guess what? On July 5th, we aren't going to need that because there's a 2% Man, they're issuing a lot of stock dividends, aren't they? A 2% a 2% common stock dividend was declared and distributed the same day. Now, this is a small stock dividend, so we do care about the market value. And so we're going to hit retained earnings, debit. I use the word hit retained earnings because we're going to reduce retained earnings, because we're going to debit retained earnings is reduction, right? Because it's a equity account, and it's going to be for so what's a 2%? Shares outstanding are 450,000 times 2%, 9,000 new shares. And so what's a debit to retained earnings? It's 9,000 times the $11. Credit common stock for 9,000 new shares times $1, and credit APIC for the additional paid in capital. All right, I'm telling you, this last problem is a doozy. And then we have, we're moving on to 12.1. All right, I'm going to get a separate piece of paper here. Now, how many shares do we have outstanding? We better do, and let's say common shares. Outstanding equals 450,000 plus 9,000, 459,000 shares outstanding. You may need that. I imagine that we're going to. It kind of makes this a good problem. December 1st, the board of directors declared an 8.8% cash dividend on the 90,000 preferred shares. And so, and that's declaration date. So we're going to debit retained earnings, and we're going to credit the dividend payable. How much? It's a 8.8% cash dividend. And that percent is going to be times the par value. What's the par value of preferred stocks? 8.8% times $90,000. That's there. You don't pick up the paid in capital because the 8.8% is going to be times the par. 8.8% times $90,000. Let's see what that would be. $7,920. Are we done yet? No, we're not. I am not done. On December 1st, they also declared a cash dividend of 50 cents per share. Well, let me say cash dividend December 20. Let's finish these out. Well, I didn't finish this one out. No entry on the date of record. And then it was paid on 29. All right. Debit dividend payable. We put it in as a credit, we take it out of the debit, and credit cash. All right, now we're at the end. Common stock dividends. the board of directors declared a cash dividend of 50 cents per share on its common shares. Let's go back. I'll go ahead and get the journal entry ready. Debit retained earnings and credit dividend payable. How many shares were outstanding? I've been tracking it. 459,000. Times how much of a cash dividend per share? 50 cents. So 459,000 divided by 2, 229,500. Date of record, no entry. Just getting a list of those shareholders that we got to pay. And when do we pay them? On December 28th. And so we're going to debit dividend payable for the full amount. And we're going to credit cash. I grade myself at 100% on that one. Okay, that's it for working equity problems. And I did look at that 1823 before I started here, and I said, man, do I really want to do that problem? You know, because I don't think I'm gonna record any more lectures today. I think I've done like 4 or 5 chapters in the last couple of days. So if you see my voice starting to trail, you know why. But I'm glad I worked it, because you see a lot of the dividends and a lot of both cash dividends and stock dividends, both large and small there. So I am glad I worked it. So thank you guys. I think, again, I mean, there's a lot there, but very, very straightforward. And so I expect for my classes to see really good scores on this chapter. Thank you, guys.